On what we just witnessed today. That was brutal.
Obviously brutal. I mean, the markets rushed toward a place to say we have to start handicapping the probabilities of a recession in this country. Certainly, we haven't priced that in right yet. The verdict is not yet in. I think you could probably look at the washout conditions in the market and start to make a case that there's been enough selling for now. If it was just an equity story, I do think everyone has one eye though on what credit spreads are doing and just the volatility readings out there, which suggest a certain contingent of market players are kind of trapped in forced hedging, and there's a lot of unease and bad vibrations in the market. That's the way it is before you get some kind of a big reversal rally, but it's also the way it is before the market deepens into a deeper correction.
Peter, on that note, what are you looking out for, the key triggers that would make you turn to be a bit more constructive, a bit more bullish again?
Well, I'm looking at the rates markets, and the rates markets have been singing a bearish tune for quite some time. The 10-year dipped to about 35 basis points.
Although it rallied up to 50 basis points.
It did. Big moves all day long. The 3-month to 10-year spread, not to get too esoteric, intraday moved 30 basis points. It was down 20, and then it was up 10. It's really a really interesting time in the rates market. So what I would like to see is a bit of a steepening in the yield curve, which likely cannot happen because Fed funds right now is still well above the 10-year. So I'm actually expecting the Fed to move at its next meeting with another series of cuts, and then perhaps I will get more constructive. But the problem is the fundamentals have been weak for a while, and the coronavirus is just, as I've been saying, an extremely heavy straw on a very weak camel's back.
So junk spreads have jumped the last 2 days, but they're still below where they were in 2015, right. 2016. So do you think we get to that level or above before the pain is over?
Well, I'll tell you, it's interesting. You know, I grew up in a world where credit markets led equities every time. A couple cycles that I have lived through, that was the case. Now I think it's different, and I think the equity cushion under credit spreads has allowed for a relative value mindset that has persisted for a long time. In other words, if you're taking down a new issue and a company has a massive first loss cushion beneath you, you're really not all that worried about being repaid. But suddenly, as your equity cushion diminishes, you say, oh my goodness, maybe I don't care about that extra 10 basis points on the break. I really care more about whether or not I'm going to get repaid at the end of the day.
Eric,
and that's the shift.